Shares of Alibaba closing lower after reporting mixed earnings today before the bell. Stock initially popped on very strong revenue growth, up 60%, before turning lower on comments from President Trump saying there needs to be more focus on trade and cracking down on China.
Joining us now to discuss it all, John Blank, Chief Equity Strategist at Zacks Investment Research, and Kevin Carter, he's founder of Emerging Markets Internet and E-Commerce ETF. John, you know, there was also some talk before the president's comments today that the company itself was sort of saying there's going to be heavier investments, concerns about margins. With Alibaba, there's often a little bit of scrutiny of the financial numbers themselves. So where did this report leave you, and has the big pullback in the stock been a warning or a bit of an opportunity?
First of all, Michael, I would say it's an opportunity. I've got a $210 price target on the range back to the June highs by the end of the year, and I've got $250 is my target at the end of 2019. That's a 20% growth target. Now, why do I like that? That's because I see the 20% earnings growth in their numbers. But what you got to understand about Alibaba is that people are casting it as an Amazon, and it's not an Amazon. It's an Amazon, a PayPal, and other things that get like an eBay. So if you put eBay, PayPal, and Amazon together, you get a much more profitable core business with 60% profit margins. That business is what's growing their market, and they're just diluting it out with their other three segments. That's a strong business model, probably lighter than Amazon, and probably able to deliver that 250 in 2019. And I think you basically get Trump out of the way sometime in the next few months, and you get to 210 this year.
I mean, today everyone's talking about how strong Alibaba's growth is, 61% revenue growth, Kevin. It wasn't too long ago, a few weeks, maybe last week, we were talking about Tencent having its first profit decline in years. So what do you do with these stocks?
Well, I think you buy them if you're a long-term investor. Obviously, Tencent had some problems with a video game they were trying to release in China, and that impacted their revenues and earnings. But, you know, if you step back and you look at the growth rate that these companies have, and these are both $500 billion market cap companies, 61% is astounding. I mean, that's hard for any business to grow at 61%, let alone one the size of Alibaba. And if you look at the the PEG ratio, the PE versus the growth rate, and if you look at the top line growth in particular, which is the most organic part of growth, the stocks are very compelling. And the media, with all due respect, a lot of the print media that I read today, said things like, if you took out this factor or that factor, the revenue growth would have only been 50%. So I think there's a high bar for these companies, but if you're a long-term investor, I think this sector is probably the best in the world to buy and hold.
John, it's interesting because this is a market that has flocked to any large tech platform with a dominant position that has that kind of top line growth. So don't you look at the way it's treated something like an Alibaba and say, what's the market telling me that I don't understand? Or is it just about, hey, there's a taint on big Chinese companies right now because of all the political stuff?
Well, Michael, you got to remember, Alibaba, I mean, there is no more marquee name in China if you're going to buy a stock. So they're in every ETF, they're going to be in any Chinese mutual fund, and they're going to be in the index, the Shanghai indexes. So they can't escape the seen one, seen them all story of the Trump trade war, and that's what's happening. So they're just too big, they're too visual, they're too liquid, and they're too traded. So they're just going to stay in the news, and they're going to be hit just broadsided, just like the market for some time to come until this trade talk that gets to resolution.